Hello, welcome. So this is the chapter 10 and this is the part 1 of chapter 10. So in this part we will be discussing about capital versus revenue expenditure, cost to capitalized, acquisition of assets, lump sum acquisition, and non-interest bearing notes. Okay, so the types of assets we have, say long-lived revenue producing assets, property, plant and equipment. We have land, buildings, equipment, machinery, furniture, autos and trucks. And the natural resources we have oil and gas deposits, timber trucks and mineral deposits. Intangible assets we have patents, copyright, trademarks, franchise and goodwill. So cost to be capitalized. So the cost that should be capitalized are, when we are purchasing something or when we are creating something. So in both the cases, we have to spend a lot of money. So the one-time money that we spend are usually capitalized. So property, plant and equipment and intangible assets can be acquired by purchase, okay, by self-constructions. You can create your own assets or you can get something from donation. We can also get some assets from business combination, from lease or from exchange, okay. And the initial cost of the asset would be purchase price plus all expenditure that are required to bring the assets to its desired condition or location for use, okay. And let's see the difference between capital expenditure and revenue expenditure. So the capital expenditures are added with the assets and revenue expenditures are usually shown, meaning presented in the income statement, okay. Okay, now let's see the difference between these two. So the capital expenditure and the revenue expenditure we can see over here. So the first one is capital expenditure to acquire or improve permanent assets that is not meant to resell. So acquiring or improving permanent assets, okay. And then revenue expenditure is a routine expenditure incurred in the normal course of business and includes cost of sales and maintenance. And capital expenditure are normally non-recurring expense. And revenue expenditure, they are normally recurring expenses, meaning they happen again and again. Say for example, in your car, if you have a Toyota or say Ford Motors, so you need to refill the oil every week or every day, okay. This is recurring expense, but the maintenance of your car is non-recurring expense, okay. So capital expenditures produces benefits for several years, okay. And revenue expenditure produces benefits for 1 year, for 1 accounting year, okay. And capital expenditure is an item of balance sheet. It is shown in the balance sheet, but revenue expenditure, it is shown in the income statement as an expense. So it becomes an asset, okay. It becomes an expense. And now let's see, the cost of equipment includes purchase price, any sales tax, transportation costs, expenditures for installation and testing, legal fees to establish title, any other cost to bring the assets to its condition and location for use. The sum of the above costs represent the initial amount to be capitalized in the balance sheet. Okay, and here is an example. So the Central Machine Tools purchased industrial equipment to be used in its manufacturing process. The purchase price was 62,000, shipping insurance 300, then special platform cost 1200, and the cost of the trials including wasted materials was 600. So we can see that all these costs are capitalized: purchase price, freight, insurance, shipping, a special foundation, and then trial runs. Okay, all of these costs are capitalized. So just pause the video and try to solve this one. Okay, you are done? Here is the answer. And here is the explanation. So the correct answer is B. So purchase price, transportation cost, installation and writing, wearing, and testing. Cost of land, purchase price, attorney fees, real estate agent commissions, costs related to title and title search, recording fees, any back taxes, liens, mortgages, or other obligations. Okay, so current portion of the property taxes are not included. Expenditures such as clearing, filling, draining, and even removing old buildings. Paging. So here is another example. So we can see that the purchase price of the building is 500,000. The company plans to remove the old building and construct a new one. In addition to the purchase price, the company made the following expenditures at closing of the purchase. So title insurance, commissions, property taxes. The 6,000 in property taxes included 4,000 of the delinquent taxes paid by buyers on behalf of the seller, and 2,000 attributable to the portion of the current fiscal year after the purchase date. So shortly after closing, the buyers paid a contractor $10,000 to tear down the old building and remove it from the site. An additional 5,000 was paid to grade the land. So here is the total cost of the land that should be capitalized. Purchase price of the land and old building 500,000. The title insurance, commissions, delinquent property taxes, cost of removing old building, and cost of grading. So property taxes, see, related to the right. So land improvements, they are separately identified and capitalized, depreciated over periods benefited by the use. Examples: cost of parking lots, driveways, private roads, fences, and sprinkler systems. Cost of building, purchase price, realtor commissions, and legal fees. Conditioning costs. And the natural resources includes timber tracts, mineral deposits, and oil and gas deposits. Benefits are derived from their physical consumption. So cost of natural resources would be, if purchased, purchase price and any other costs necessary to bring the asset to condition and location for use. And if developed, acquisition costs, exploration costs, development costs, and restoration costs. Okay, lump sum purchase. Sometimes we purchase multiple assets. So we are purchasing, say, 1, 2, 3 assets, and we are paying a lump sum money. Okay, so we need to allocate the lump sum amount to these assets. Okay, we need to allocate lump sum amount to these assets. So that is what we are going to do. So we usually allocate the lump sum amount based on the fair value of the individual assets. So each asset is indistinguishable in that case, and 10 identical delivery trucks purchased for a lump sum price of 150,000. Let's see what are they. So the assets have different characteristics and different useful lives. For example, acquisition of a factory that includes assets that are significantly different, such as land, building, and equipment. Okay, and here is an example. See that. Okay, so the company purchased an existing factory for a single sum of 2 million. The price included title to the land, the factory building, and the manufacturing equipment in the building, a patent on a process the equipment uses, and inventories of raw materials. An independent appraisal estimated the fair values of the assets. Okay, let's see. So the fair value of the asset land is, see, 330,000, correct? So, and this is the fair value of the asset, of the land. So what we are doing, so we need to calculate the percentage of the total value. So total value is 2,200,000, meaning, okay, and now, so what we are doing, we are dividing this 330,000 by this total amount, okay, 2,200,000. So the land is, meaning the value of land is 15% of the total value. So this 15% of the 2 million, okay, this 15% of this 2 million will be allocated to land. Okay, so now let's see how we allocate. See that this 15% is for land, then 25% for building, equipment 30%, patent 20%, inventories 10%. Okay, this is how we allocate. Okay, and the journal entry would be, so all the assets, meaning the amount that we have allocated to different assets, land, building, equipment, patent, inventories, they are debited and cash credit. Okay, here is a problem for your practice. So pause the video and try to solve this one. Okay, done. Now here is the answer. Answer is C. And where is the solution? Non-cash acquisitions. Companies can also acquire assets without paying cash at the time of the purchase by deferred payments, notes payable, issuance of equity securities, and donated assets, exchange of non-monetary assets for other assets. Okay, deferred payments. Sometimes we purchase assets and we sign a note. Okay, say for example, when we are purchasing cars from the auto dealers. So what we do, we pay some and we agree to pay the remaining amount in installments. Okay, that is actually deferred payments. Okay, see that machine is acquired for 15,000 and they have signed a note requiring the payment of 15,000 sometime in the future plus interest at a realistic rate. So in that case, machine debit and note payable credit for the same amount. Okay, and present value of note indicative of fair value. So this is a very good example. So on January 2nd, 2021, the Midwestern Steam Gas Corporation purchased industrial equipment. In payment, Midwestern signed a non-interest bearing note requiring 50,000 to be paid on December 31st, 2022, 2 years later. Okay, so So if Midwestern had borrowed cash to buy the equipment, the bank would have required an interest rate of 10%. Okay, so now let's see. So the value of the equipment on that date is 41,323. How? See what we have done. We have calculated the present value of this 50,000, correct? So how? This is the present value factor. I will show you in the example, the problem that we will solve. So equipment debit, discount on notes payable. So how we have found this discount? So the difference between 50,000 and this one, okay? This one is our discount on notes payable, and we will discount this one based on the interest expense. Okay, and let's see. So interest expense on December 31st, 2021. So the value of the, the value was okay. So the value was 41,323. So, and now we will calculate the interest 10%. Okay, discount on notes payable credit now. So interest expense debit and discount on notes payable credit. Okay, meaning we are crediting discount on notes payable by the amount of interest we are calculating. Okay, and December 31st, 2022. So you can see that. So here, this capital amount plus this interest, so total, and now we are calculating interest, 10% interest on this total. Okay, and finally we are paying notes payable debit, so cash credit. Okay, now let's go to solve some problems. So in the next video we will be solving some problems.